Hey guys, this is a market update. Capitulation is the word for this video. I will show you who is capitulating right now, but why I want to take advantage of this time because of what's happening in the future. We're going to go through this report by JP Morgan as well in terms of where they see the industry going. I'll leave timestamps in the description. Right here on Bybit, we can see that we are still within this consolidation period after the FTX blow up. Now, as I've said in previous videos, who was actually selling right here? Well, it wasn't investors. It wasn't long-term investors. It was barely even traders. We'll see some stats on that right now. We are still within this 24% drawdown from this price right here. Again, still in a downtrend and a consolidation. We have not broken the 100 period moving average. As you can see, each time that we come into this 100 period moving average, we just get rejected, and we've been rejected again. So best case scenario is a consolidation here until that 100 period moving average again. And then we'll go from there to see if we can actually break into a new market phase or whether we capitulate once more. Is there any more capitulation? If you are a trader, deposit bonus on Bybit up to $4,000. Link in description. If you are a trader, they're giving free spot trading across all spot pairs as well at the moment. So if you do buy, check that link in the description. If you're an investor, take your crypto off onto the blockchain for safekeeping. Before we get into the JP Morgan report, who is actually selling right here? Well, as you can see, it is Bitcoin miners. That makes a massive load of sense. Bitcoin miners are unprofitable. They will be selling their Bitcoin, turning off their rigs. And this is a cycle that plays out over and over and over again. As you can see, they are dumping Bitcoin on the market, which is why you've seen BNB coin, Ethereum, Matic performing so well against Bitcoin. It's because they don't have mining infrastructure and they don't have miners that need to sell. But as we say, short term and long term, very, very different, right? Over the very long term, Bitcoin for me is expected to continue to grow much larger than other chains which have, more specific use cases. And so we can take advantage of short-term price discrepancies based on these events. And we have, the next halving over in 2024 that is going to start driving up speculation in the price again. And so as we can see right here, this dump, even though it was around the time of FTX, it was actually caused by miners selling, as you can see here. So miners were dumping, they were fed up, they could see a huge capitulation event with FTX, miners dumping. But as you can see from this Glassnode chart, who was actually accumulating during that time? Well, it's shrimps, what they call shrimps, I believe, which is under 1 BTC. JP Morgan have put out this report, which is where they see crypto going, and institutions are coming on board, which if we want all our bags to pump, then they do have to come on board and obviously pump our bags. So let's see what's actually happening right here in terms of the regulatory landscape, right? And where we're going in 2023 and onwards, which is actually going to bring some safety into Bitcoin and bring in much larger investors. As we argued previously, the collapse of FTX is likely to increase investor and regulatory pressure on crypto entities to disclose more information about their balance sheets. So that is essentially all of these trading venues offshore trying to move onshore and potentially being blocked if they don't. Then we have more diligent risk management, including management of counterparty risk among crypto market participants. This is something that's actually very difficult for any regulator to keep an eye on if it is abroad. And so we will see, hopefully, regulators moving to actually regulate crypto exchanges rather than just push them offshore, which is not a good thing for anyone. Here are the main changes we envisage post-FTX. Now, Europe is way further ahead than the States in terms of regulating and bringing this into the mainstream. The US is running around like a headless chicken, trying to argue over these things, which is ridiculous. But, the European bill is not perfect by any means, but at least it's a framework and an infrastructure to work off. This is MiCA right here. The final approval is likely to take place before year end. That's this year, right? So you're going to have at last an actual framework that people can work in, and these proper institutions that aren't going to lend your money out to hedge funds and go bust during a downturn, right? Transitional period of up to 18 months before the regulation takes effect. So, these things happen very slowly, but it's, happening right now. Important rules for the crypto industry. Marketing guidelines for crypto companies, requiring them to provide detailed information about their project. This already happens, but virtually no one actually reads this stuff. So it's really important to have some marketing guidelines, right, in terms of if you're paying 10% yield or something like that, where is you getting that yield, right? And actually letting people know. It also mandates stablecoin issuers to maintain ample liquidity in the form of deposits to prevent crashes like that of Terra USD. You know, all of this is, you know, closing the stable door after the horse has bolted, right? These things have already happened, but you know, they could happen again if these regulations don't come in, but at least they are coming in. It also restricts stablecoin issuers on how many tokens they can issue if they are not denominated in euros or other EU currencies. This is a really big issue because no one trades euros, but you can see, and this is really important, right? You saw Circle, who make USDC. They have started Eurocoin, and there's the reason for this is because they're working with regulators right here, and the regulators have said you can't have more than $200 million of USD stablecoins, and so you need the Eurocoin. So that's why they made Eurocoin. I think USDT are doing this as well. Now, really important here is that there's a few different classifications of crypto assets, which I think is important. Firstly, under MiCA, cryptocurrencies are divided into 4 categories: crypto assets, utility tokens, asset reference tokens, and e-money. So let's go through what those are. E-money is the same as what is actually online already. So if you use something like Wise or Revolut, right, they're an e-money provider in the UK. E-money is actual currency from the government. It's government currency. So e-money is government currency that is just one for one with government currency. Now, as you can see here, ART, these are asset reference tokens. These are USDC, USDT. So they are not e-money. They are more like money market accounts that have some different regulations. So they may include fiat currencies, but they may also include treasuries and other debt, right? So they're more like a money market account. And then you have other crypto assets. So basically you have money, you have e-money, and I'm sure this, you know, the CBDC is going to come in here, but then you have, you know, pegged assets, right? Like those stable coins. And then you have other crypto assets, which come under regulations where you have to submit white papers, you have to get approval for them. That makes sense. But also, where do actually, you know, something like Bitcoin come in? It looks like they're going to be commodities, crypto assets that are rewarded for maintaining DLT or distributed ledger technology are going to be exempted from MiCA. That's layer 1 tokens, right? Like Bitcoin, presumably under this, Ethereum and other L1 tokens potentially going to be exempted as well, as far as I can see. There's no distinction between proof of work and proof of stake in this, but that might come later down the line. But it looks like, in Europe anyway, L1 tokens are going to be exempted because basically they're commodities of their system, whereas they're really focusing on money itself and having regulation around that, which is, in my opinion, a good thing. And it sets the stage for actual real, you know, companies that aren't running clown shows to actually come in and provide these services. Now, once more, on the American side of things, Bitcoin is a commodity and doesn't need regulation. If you want to hold it or trade it, then you need regulation as a company. But Bitcoin itself, there's no regulation required. As you can see here, oversight of cryptocurrencies and their intermediaries, such as Bitcoin, that are not classified as securities, but rather as commodities, could fall under the CFTC. Trading, custody, and everything like that needs to be regulated. That's company regulation. Bitcoin itself is a commodity, and that regulation is only going to help us. You can still keep it in a decentralized wallet if you want, but the plain fact of the matter is that most normal people are not going to do that, and they just want to see Bitcoin in their bank account or something like that. Well, at least these rules are going to provide a framework so that large companies like JP Morgan, Goldman Sachs, where the big money is, are actually going to start to come into crypto. The MVRV ratio is showing a historic move for BTC. This is a ratio that shows you kind of the strength of the price and where we are. Now, this is the 5th time we've been in this zone. Each previous time has shown the absolute bottom of a bear market before I move to the upside. You can see that right here and on these occasions. Now, we've actually touched this twice. The first one was the Celsius and 3AC, and then this one is the FTX blow up right here with the minor capitulation. Now, this is known as a bottom signal, considering that each previous time we've got to this level has been the bottom of a bear market. But of course, it cannot predict what's happening now, how long we can stay here. Maybe the price goes lower and just stays in the range for a little bit longer. You really can't predict those. But if you're using any sort of analysis to try and time entries between bear markets and bull markets, this is predicting them, right? You can see whenever it gets up into this top range was the top of a bull market, which is not areas where you go long. And when you're at the bottom of this range, that would have typically in the past been a fantastic buying opportunity. Of course, we can't predict prices, but this speaks for itself, I think. In terms of the price, what I really want to see is some sort of strength through this 100-period moving average. We've just been under this the whole time, haven't broken through it, been rejected off of it a lot of times, minor capitulation, FTX. So let's see if we can actually consolidate and try and actually move through this 100-period moving average into some sort of strength. That will actually be a positive move. I think you need both of those in tandem. If you want to trade on Bybit short term, up to $4,000 deposit bonus. If you're an investor, commission-free spot trading right now, so you can buy on there and then take it out to your wallet. I'm James with MoneyDG. Cheers for watching, and I'll see you in the next one.